Hey guys, Sean here. Things are really getting from bad to worse, and this recent market rally might not last. The S&P smashed headlong into a bear market, falling by 20% from its peak down to the abyss below 3,900. He has been heading up a bit and everyone in the mainstream is cheering, but it looks suspiciously like a dead cat bounce. It's kinda gasping for air before the real crash happens, and this is where we have a chance to start accumulating assets. Now I'm talking about stocks when it's cheap, I'm talking about real tangible stuff like physical gold and silver when prices are low. Because at the end of the day, you really don't want to be hanging on to your paper cash for too long. Now, CNN's greed and fear indicator shows us that everyone is panicking. Everyone believes the sky is falling down, but I just don't see it. I really don't see the extreme fear where everyone is running around like headless chickens just yet. But the fundamental situation is clear. The Fed has to raise interest rate. They are going to have to pull out money of the economy, and they are going to do it in June. And every time the rate goes up, it adds more pressure to the economy. But here's the funny thing. Right now, unemployment is at an all-time low, labor demand is still high, and people are demanding higher salaries, but corporate profits are down. Companies don't have much wiggle room, and if we slip into a recession, oh boy, higher rates with lower revenue will just crush the markets. This whole situation can suddenly shift if the Fed hikes too aggressively, and once layoff happens, we'll officially be in stagflation where we have a recession kicking our ass on one hand and inflation eating us alive on the other. And that's why we have to get prepared if this house of cards starts to crumble. Because if the crash is allowed to fully play out without any QEs, without any money printing like in '08 or 2020, we have literally no idea what the true bottom will be. Michael Burry, the guy who timed the '08 housing crisis, views this market slump like watching a plane crash and is predicting the mother of all crashes for the market. And if he is right, this might be a once in a generation opportunity to build wealth from ground zero. But first, we need to quickly reframe our minds to understand how it would be like to buy into a market crash. Because in the past 10 years, we have only experienced a non-stop bull market. Because there will likely only be 3 baseline scenarios of how this crash could play out, and we need to quickly cover them. Firstly, the Fed slowly tightens all the way to bring inflation down to 2 to 3%, and the system doesn't break and a big crash doesn't happen. Now, this is the ideal situation where there isn't too much pain and everyone more or less wins. It'll be business as usual, markets will gradually fall, and the dip will quickly bounce back once the Fed declares victory. This is why we see Powell taking baby steps with his rate hikes and announcing his hikes months and weeks beforehand, because he's trying to get the market to price in all the bad news first. He is slowly trying to boil the frog alive. Hey, it could happen, right? Anything is possible in today's crazy world. The second scenario is the Fed tightens all the way or halfway and something in the economy breaks. Maybe it'll be the housing market, maybe it'll be the corporate debt bubble that pops. Now, if that happens, then all chaos will break loose, fear will spread through the markets like wildfire, and everything could fall in price. Remember that the S&P 500 fell by almost 50% in '08, and it took around 6 months for the implosion to fully play out. But this time, it could be worse as the S&P now has 28% in tech, and the last time it was that high, it was back in 2000, and we know what happened when the dot-com bubble burst. And the last scenario is a U-turn of the Fed's policy, and they could either slam the handbrakes and start lowering rates again, or they could pump money back into the system. Now, any of these 3 scenarios could happen. It's going to be quite crazy to predict which will happen. Now, it's really time to come up with a plan to start buying assets and start accumulating real tangible things. Because if you stay still, guys, inflation will just eat up your purchasing power. There's no doubt about it. If you try to time the dip, scenario 1 or 3 could come true and suddenly the market rockets up again and you're left out in the cold. So let's take a look at our options and we'll look at the 3 big boys in the room: stocks, gold, and bonds. So let's talk about stocks first. Now, this will be the automatic go-to asset class that the masses will all flock to. Every mom and pop, man on the street, hedge fund manager, and even your mother knows the S&P 500, and when they think of investing, they think of stocks. And if you believe in the general stock market, if you believe the American economy won't go bankrupt yet, then buying into the S&P is an avenue to really acquire shares in companies when the market is down 20, 30, or even 40%. Remember that when the Fed saved the economy with money printing back in 2020, one of the first places money was deployed to was back into the stock market. People with their steamy checks started opening up Robinhood accounts at home and began buying everything up that looked familiar or just sounded cool, together with the S&P of course, and this moral hazard will happen again. And if money is printed to save the system, we need to appreciate the fact that even if it's just to inflate the bubble, once again, this is where money will flow to. Now personally, I'm accumulating a mixture of S&P 500 through Vanguard's VOO as well as buying VT, the total world index, which gives me exposure to thousands of companies in the world beyond just the United States. It's a play down the road that the world economy will recover and it will become bigger than what it is today. Let's talk about gold. Alright, you probably know that I'm very biased towards gold because I've studied it for too long and I've been buying it since 2013. And if we take a look at the price of gold, it's actually holding up extremely well against stocks, and it's actually up by 2 to 3% when everything else is crashing to hell. Gold has been a great hedge against inflation, especially when the Fed prints money and actually moves even faster than equities if that happens. We can see that immediately after money printing, the move up for gold is more violent. Let's consider the situation we are in right now. Stocks are going down, inflation is still high, and bonds, which we'll talk about in a bit, are not paying enough interest to fight inflation. So if a market crash does happen, yes, gold as well will also fall. Almost every asset class will. But if you are betting man that the Fed will come to the rescue or that inflation will still be sky high, then you definitely want to pick up some gold. It's a no-brainer, right? For the big picture, we know that this modern monetary theory isn't really working, and sooner or later there will be a return to sound money. Maybe gold will be backing up a whole new world currency, or maybe more central banks will just be buying more and start hoarding it. Either way, I'm accumulating more gold as the markets get smashed down. Lastly, let's talk about bonds. Now, this is a really interesting asset class today because in the long term, it looks really horrible with an inflation rate of over 8% and bonds just paying around 2 to 3% at best. But we need to also pay attention to the short-term story, especially the mechanics of how hedge funds and mutual funds think, because those are the prime market movers, especially when it comes to fixed income and bonds. Now, the thing about these funds are the investment mandates they have, and that means they can only invest across a certain universe of assets, right? You won't really see the majority of hedge funds suddenly buying up physical gold and silver. It'll be mainly stocks and bonds. Maybe only smart technology companies like Palantir are actually doing so. But anyway, this means there's always the possibility of big hedge funds moving tens or even hundreds of billions of dollars into bonds as a safe haven bet. Now, I know that sounds ridiculous, but it's entirely possible when everything else is cratering to hell. So we could have an instance where stock starts crashing and the pain, it just gets too great, right? And they might flood into bonds because at the very least, they won't lose money, and the 2 to 3% gain is better than an additional 20% loss. Now, this will push up bond prices, and it could be a decent short-term speculative play if you have the stomach for it. We're really seeing this move in the bond market in both the long-term bonds and short-term corporate bonds. They are going up right now. But for the big picture, bonds aren't going to make much sense when inflation is so high. And if inflation continues to trend higher or maintain its level and the stock market falls enough, we could see the bond bubble eventually burst and a move of money to stocks into gold and silver. It's really going to be an epic move. But whether you decide to buy stocks or gold, it's important that you don't fight the Fed, and that means your choices have to align with the actions of the Federal Reserve. Now, if they decide to print money and flood the system with liquidity, it's time to buy aggressively and ride the money wave up. And if they're raising rates and pulling money out of the system, you need to be cautious and plan your investments very carefully. It's time to be conservative. And that means you need to accept that rates, at least for now, are going to go up. And this brings us back to the best strategy when the market is falling, and that is dollar cost averaging. I know you're sick of hearing it, but it is one of the superior strategies when things are going down, because if markets are going to gradually fall, if rate hikes and the selling of bonds from the Fed are going to play out to the fullest, then lump sum investing just doesn't make sense. You are trying to predict the bottom, which can't be done. Remember that we are most likely entering a bear market crash where volatility will be extremely high. Just take a look at the S&P 500. It looks like a whole lot of denial and bulls trying to fight back. In this case, dollar cost averaging just makes more sense. If you threw all your ammo when the crash first started, you would have missed out on many buying opportunities along the way. But if you just chopped up your investment and bought in once or twice a month, you would have gotten a much better average price over time. Now, we all don't have a crystal ball and we won't know what will happen down the road. But if you look back at history, it takes on average 8 to 12 years to experience a crash, and since the dot-com bubble, the Fed has caused bubbles by their low interest rates and then saved the economy with money printing. It's becoming quite a bit of a tradition, and I personally don't see this pattern changing anytime soon. And this means if we have the right mindset of accumulating assets, even when the market starts crashing, if we stay the course, dollar cost average in, and we don't try to crystal ball the market, then we can come out ahead. Because I think the world's really going to be split into two camps: people who have assets and people who don't. People who own real tangible things like shares in a company, physical gold and silver will survive. Because right now, inflation is already draining the bank accounts of people with all the price increases in food and fuel. It's getting crazy out there, and as sad as it sounds, all they will have left is paper money, while the people in control will have assets, right? They'll have ownership and they'll have hard assets. Let's address another big question. Should you buy the dip? And I assume this is in addition to dollar cost averaging, because if your strategy was just to buy the dip, oh boy, I think there were only 3 or 4 dips over the last 13 years. You would have missed out on massive gains. But if you combine buying the dip together with dollar cost averaging, then yes, you would make out like a bandit, but that is considering if you have enough money to make it happen. Because what I define as a dip will be different than what you see is a dip. I know people with deep pockets, very deep pockets, that buy every time the market drops by 2 to 3%, in addition to putting money into the market every single month. So they accumulate gigantic positions all the way down, and when the market rises, suddenly everything is in the green and they are up massively. But the big risk is that you become trigger happy and you finish all of your ammunition before the bottom is reached. Remember, it took around 18 months for the housing crash to bottom and almost 2 years for the dot-com crash to end. And that's why I personally just stick to dollar cost averaging, because I don't have unlimited amounts of money. Yes, if the market suddenly crashes 5 or 10% in a panic, I'll pile on a bit more, but I'll still be buying in periodically. But you have to do what's most comfortable for you. If you have lots of money, you have tens of thousands, hundreds of thousands, millions of dollars, then you can afford to aggressively accumulate assets. I think one of the hardest situations is navigating through this market crash, and if you're sitting on a pile of losses, I get it. I understand the pain of seeing everything in red, plus it sounds unthinkable to you even now to add more to your positions. But honestly, what other choices do we have? Markets are imploding, maybe only gold is still holding strong, and if you bought it in the years before, now you can see the definition of a true store of value, but even that could crash if things get ugly enough. So let's quickly think of it this way. Say you were buying all the way up. You were progressively paying higher prices until things started to implode in January this year. Does it really hurt to be buying all the way down when you can get assets for cheaper with each passing week? Something to think about, right? Because if you're a true dollar cost averager, that is what you should be doing already. Now, if you believe that one day the markets will recover, if the apocalypse isn't here yet, and if aliens aren't coming anytime soon to destroy Earth, then buy assets. Scoop up deals, guys, and position yourself for the upside. Because there's still one gigantic bubble that's still growing and it hasn't popped yet, and that is the bond bubble. Now, this is a multi-trillion-dollar debt bubble just in corporate bonds alone, and over $100 trillion globally. And every time rates goes up and inflation stays high, bondholders will be slowly inching towards the exits. And once they decide that it's enough and it's back to risk taking, that money will naturally flow into only 2 exits left: the stock market and commodities. It could be one, it could be both, and that's why you need to position yourself if that happens. So let me know what you think, guys. Do you believe we're at the brink of an epic crash, or is this just a blip and we are still melting up? Let me know in the comments below. Be sure to smash the like button and subscribe. Thank you all for watching, and I'll see you soon.